Hello, this is Brian Shannon from Alpha Trends Blogspot. It's Wednesday, the 21st of November, 2007, and the market's closed. And once again, we had selling on Wall Street today. S&P lost nearly 2%, and so much for big volume without further downside progress equaling accumulation. The selling was quick from the open this morning as the market did gap lower. It attempted to recover with a couple of higher highs and higher lows, but at the end of the day, the sellers came back in and showed their dominance and took the market lower once again. So, yesterday I was saying that I thought that perhaps the market was due for a bounce based on the fact that it looked like it's gotten oversold. It had a positive close and traded the biggest volume it's seen since back in August. But once again, the only thing that pays is price. Volume, moving averages, Fibonacci, fundamentals, any kind of news out there is all interesting and good to know, but at the end of the day, the only thing that pays is price. And clearly, in a downtrend, you've got to be very careful. Yesterday I was saying that there's no signs of a bottom except for potentially this volume, and that we're in a very, very bearish environment with all these moving averages heading lower and the market rather, stuck below them. So the path of least resistance is lower. If you did take a trade, like I said yesterday, there's no reason to be holding overnight, in my opinion. And the opening weakness should have kept you out of it, unless you're an aggressive trader, where perhaps you were looking at the one-day chart. And in here again, look at the daily VWAP. Early on, it kind of the buyers and sellers were really fighting for control. Looked like the sellers were in control, and then buyers took back that control for most of the day, as the market never turned positive, but price being above the daily VWAP, or the average price that it closed at on a volume and price basis, the market was above that, and then as it came back down once again late in the day, we had further selling on another increase in volume. You can see that these two drives lower were on increased volume, and the consolidation was on lighter volume relative to the event being the sell-off. So again, the path of least resistance is lower. The market never made it back, and what I was really looking for, what I thought maybe the buyers could take controls if it got back above 146 or so. Now we've still got all these levels of lower highs that are going to act as resistance on the way up, and we've still got the declining 5-day moving average that gives the benefit of the doubt to the sellers in here. So hopefully, it wasn't a bearish event for you today. We are getting more sold off on the weekly time frame, but that doesn't mean you should buy. There's still a lot of trouble in this market, evidenced by price first and foremost, and that's what pays is price, and that's what you have to spend most of the time looking at. We're definitely oversold. We got oversold a few times, but it doesn't mean it can't continue lower. So odds favor probably some kind of bounce, but until it actually materializes, you can look at seasonality, you can look at volume without further downside, and all that makes for interesting study. But again, the only thing that pays is price, and now we're going to need to get at least above, I think, 145 before this market has the potential to turn once again. And I'd say, just to be more conservative, probably above that 145.5 level. And that's still 4 points away. So again, do you wait? Would you actually buy it if it rallied up to there? It depends on how it got there. If it made a nice series of higher highs and higher lows at that level, and then broke past it, let's say that was at 145.5, then perhaps you buy it on a breakout with a stop below the prior low. But I think for now you still have to concentrate on the shorter term time frames, or sit on your hands, sit on the sidelines, and say this just isn't my type of environment. Cash is a position, and when the market's declining like this, just to keep throwing your cash at trying to pick a new bottom doesn't make any sense at all. The IWM has been the weakest group, and continues to be. I guess I was drawing some lines in there earlier today. Well, let's take a look at that again, because I don't think it was updated properly. It looked like maybe this market was starting to show some signs of being able to turn. We've seen that 73 level tested numerous times here, and again, that was basically our target. If you remember from this head and shoulders pattern, we're on a 30-minute time frame now. I just switched over. The height of this measured down to about $73 a share, as well as the height of this head and shoulders pattern on the daily time frame, measured down to that $73 level. If you take the height of it minus the breakdown point, gives us a $23 or $73 target, which is also coincident with these August lows. So the market's down in that area, but it just continues to act terrible. There's not a reason to buy here. What I was looking at again on here on the 10-minute time frame, we just changed the scaling a little bit, is, this downtrend line looked like it was being broken. But again, breaking a downtrend line doesn't signal a reversal. What it means is the rate of descent has slowed. Perhaps we're starting to bottom. Now it's going to need to at least get above here. But again, I think you want to be more conservative. Wait for this 5-day moving average to flatten out, prices to get above that, and then potentially the market is ready to turn. But even still, you're going to see lots of levels where there's the potential for resistance if this market is able to turn around. So it remains, especially the IWM, with that 50-day moving average declining and below the declining 200-day moving average. That's the definition of a bear market, not down 10% or 15% or X number of stocks up versus down. It's the action based on the short and longer term trends represented by the moving averages on the weekly time frame. And you can see that this is the first time in years where we've seen a declining, that's the red one, moving average below the declining green one, which is the 40-week or 200-day. Here, the 50-day moving average was below the 200 right in here, but the direction of that 200-day moving average was still advancing. Now we've got it turning lower, and that's the difference. That's what puts this market, the Russell 2000, in a bear market officially. Bear markets do get oversold bounces, and they're good for a trade for a day or two, but that's about it until the market can turn itself around. I said, I think a week or two ago, take this weakness seriously. This market has serious troubles, and the IWM led this market higher over the last 4 years. Now it appears to be leading the market lower, as does the semiconductors. The semiconductors, again, they broke that 450 level weeks ago, and it's just been really a free fall. There's really no signs of support for this market. Maybe we're going to go test these levels. Anyone's guess is as good as mine. But we've certainly lost 20% very quickly here, and that's a large sell-off. One of these days, there's going to be some kind of catalyst that excites people, and we may get that sharp, violent rally higher. But it's most likely something that if you're still holding some longs that you want to liquidate into, or look for a refailure of a retracement, and then look to potentially get short. If you take just a retracement here, we could easily see, I think, a rally back up to that 440, 445 level. That, I think, would probably offer a lot of resistance in this prior level of support area. So again, the market remains in a lot of trouble. The Nasdaq 100 has been the strongest, and on the weekly time frame, it still does look the strongest, but we keep coming down to this trend line. And again, I'm not a Elliott wave guy, but basic Elliott wave is that we've got 5 moves before reversal. Basically, rally, reversal, rally, reversal, rally, and then the real reversal comes, and then what we'll typically see is a lower high, and then 5 moves in the opposite direction. Again, I'm not an Elliott wave expert, so look into that for yourself. But we do see this market coming down to the rising 200-day moving average, and that's what I really keep looking for, is for it to maybe come down, wash out to that level down near 48, and then maybe we experience a little bit more neutral to slightly upside. But again, this market is in serious trouble. There's really no reason to look for any sustainable buying until this market can really get past some of these key levels on the larger time frames, and it doesn't look like it's going to happen for a while. The market corrects 2 different ways, either through price, which we're experiencing now, and if they don't scare you out, they'll typically wear you out as the markets correct through time. So on the 10-minute time frame, it's just a mess in here. Realistically, though, this market is still the strongest, as it's really taken on a more neutral look, but with a declining 5-day moving average, it gives the benefit of the doubt to the sellers. But it's really, we've got these lower highs, but we've also got higher lows. The path of least resistance on the larger time frame is lower, so I still wouldn't be surprised to see a test of that 48 level. Friday is a holiday shortened day. It'll be a half day. So, nothing was supposed to happen this week either, Monday through Wednesday. But we saw 3 days of strong selling. And, so have a great Thanksgiving. And we'll be back to this madness on Friday.